Now that I've reacquainted you with the idea of risk and return, let me talk about the specific costs of capital that a company faces. First of all, let's talk about the cost of debt. The cost of debt, abbreviated with KD, is going to be the yield which is demanded for bonds issued by a particular company. In other words, bonds of a specific amount of risk are going to have a specific amount of return which is demanded. When we're solving for KD, we're going to solve for I in our time value of money relationship. We'll use our financial calculator and solve for I, annualize it if necessary, and this will give us the interest rate that a company would face if they were going to borrow money right now. In other words, our costs of capital are forward-looking numbers. It's what an investor will demand from future performance. Therefore, if the company were to go out into the open market and raise funds, this would be the rate of return which investors would demand on that money right now. KE, or cost of equity, is the required rate of return for common equity. Now there is one way that we can derive this, which we understand already, and that's the dividend discount model. We know that we can figure out the price based on the expected future dividend, the required rate of return, and the growth rate. But we can also solve this for the rate of return. So if we rearrange that formula just a little bit, we come up with this relationship. R, the rate of return, is equal to the expected dividend divided by the price, and then we're going to add whatever the growth expectation is. And since R is the required rate of return, KE, our cost of equity, is going to be the same thing. The cost of equity would be the expected dividend divided by the price right now, and then add the growth rate to the result. In an exam situation or in the homework, there's one easy way to test the result that you get, and that is to plug the answer, the rate, back into the formula that you already know works. If you've got the price and the dividend and the growth rate and you don't know the rate of return, you can solve for it using the formula that's shown on the screen. And you can then test your result by taking the dividend and divide it by the difference between the rate and the growth and see if you come out with the correct price. But in addition to that, there's another way that we can find the cost of equity. This is called the capital asset pricing model, or the CAPM. The capital asset pricing model uses economic figures in order to figure out what the required rate of return will be for a company based on how risky it's perceived to be. So here's the formula. KE, or cost of equity, is equal to the risk-free rate, RF, plus another factor. And that other factor is going to be beta times the return on the market minus the risk-free rate. That funny-looking B is actually the Greek letter beta, and that stands in for the amount of risk that an asset poses, the amount of ups and downs that we're expecting a particular share of stock to show us, for example. And RM stands for the return expected on the market. Now, if we take the required rate of return that the market is demanding, minus the risk-free rate, remember we've got a risk premium. So what we're looking at really is the market risk premium, which is sometimes abbreviated MRP. So you might see the CAPM formula in either of those two forms. It might be KE equals RF plus beta times RM minus RF. Or it might be simply KE equals RF plus beta times MRP. Now, because the costs of capital are forward-looking numbers, it means, again, that this is what an investor is going to demand from future performance of a share of stock. What this means for the cost of equity is that this is going to be the expected rate of return which the company is going to have to deliver based on the business projects that they're going to use these funds for. If a business goes out into the capital market to raise money, whether it is debt or it is equity, the cost of capital is the amount of return that the company is going to have to be able to give back to that investor, the lender or the equity investor, in order to keep them happy. If the investor is not happy, they wind up selling their security, which drives the price down, which increases the cost of capital for the company in the future. Let's talk about beta. That character beta represents how well an asset's return will correlate with return on the market. Now, we introduced the idea of volatility and standard deviation and kind of refreshed your memory on that. But what that means on a day-by-day basis is that when the stock market goes up, a share of stock will probably go up and in a similar sort of a proportion. And when the stock market goes down, a share of stock will probably go down and in a similar proportion. All that beta is going to do is it's going to measure how well those returns correlate. So on the chart shown, we're seeing the results of a plot of a bunch of data we're looking at the return on the market on the x-axis, the horizontal axis going side to side, and we're looking at the return on asset A, which is on our vertical axis going up and down. The points are going to be plotted, and we're going to find what the best line is that fits that. Now, in statistics, you figured out the best fit line and the least squares model and things like that. You're not going to have to compute that specifically, but you need to understand that beta is the slope of that line. You can use Excel to plot the results on a scatter plot and tell it to put a linear trend line on there and show you the formula for that line, which is what I've done with this chart, where it says linear for A return. It gives a little formula, y equals 1.0893x plus 0.0637. The 1.089 times x is going to be the slope. This is the same basic formula that you learned back in algebra when you were figuring out the slope of a straight line. Y equals mx plus b. M was the slope. In this case, instead of m, we're using beta. So beta is really the slope of that line. How steep is the correlation? If it's 45 degrees, if it's 1.0, it's going to be a one-to-one relationship with the market. When the market goes up, asset A goes up an equal amount. When the market goes down, asset A goes down an equal amount. Not in dollars, but remember in percent return, in the amount of change that we see during that time frame. When we're looking at beta, what we're really measuring is the systematic risk that this company is exposed to. In other words, the things that drive the stock market up and down, the economic factors, will also affect this business and the company's stock. So the company will be exposed to systematic factors, and it's going to go up or down based on its sensitivity. So the sensitivity that we've got is really unsystematic risk. The difference between systematic risk and unsystematic risk is this. Systematic risk is something which applies to the entire economic system that this asset finds itself in. It applies to everything in that system, and therefore when the economy does well, we're going to see an overall improvement, and when the economy does badly, we're going to see an overall deterioration. We cannot diversify economic risk or systematic risk because all of the assets in that market are exposed to it. However, we can diversify away unsystematic risk. Unsystematic risk is that risk borne by the specific asset. And this might be a result of the business decisions the company has made, the capital structure it has made, or the markets it has chosen to enter into. It might be the result of specific management decisions which have been made, good decisions or bad decisions. But we're going to see a certain amount of ups and downs, which are going to be the volatility above and beyond what the market itself is doing. Mathematically, when we're looking at beta, we're really just taking the correlation of these points and seeing how well does this line fit. So theoretically, it is possible that we could have a slope of anything. We could have a very, very steep slope. We could have a very, very flat slope. We could theoretically have a beta of 0. There would be no correlation at all between the performance of the stock and the performance of the market, based strictly on the sample that's been chosen. And it's also possible to have a beta which is negative. So let me talk about this for a moment. It is possible in real life to have a negative beta. I've taken an example of the Craft Brew Alliance. When I pulled this data off of Yahoo Finance, they actually had a negative beta. They had a beta of negative 0.32. What this really implies is that while the market is going down, Craft Brew Alliance has been doing well. Now, this is during a bad economic time, and so it kind of makes sense that a beer company might be doing well. People are going to maybe scale down, and instead of drinking Macallan's Scotch, they'll be drinking a craft brew. All right, they'll be drinking some sort of a high-quality microbrew instead. They've lowered their expectations that this company is going to be doing a little bit better in the bad economy. What does this imply about the performance of Craft Brew Alliance if the market starts to improve, however? Would we then see, during a time of economic boom, that this beer company is going to do badly? That's what a negative beta seems to imply about it. And moreover, what would happen if we plugged a negative beta into our into our capital asset pricing model? If we have a negative beta, we're actually going to be taking the cost of equity and making it smaller than the risk-free rate. We'll get into that when we get into examples. Determining the cost of preferred equity with the dividend discount model is pretty straightforward. If we're looking at the present value of a perpetuity, or the price of a share of preferred stock, being the dividend divided by the required rate of return, we can rearrange that easily enough to identify that the cost of preferred equity, or the required rate of return, is going to be simply the dividend divided by the price. So in this example, if XYZ Company has an 8% preferred stock with a $20 par value, which is selling for $28, we can figure out the cost of preferred equity by first figuring out the dividend. 8% of the par value is $1.60. Take that $1.60 and divide it by the market price, the $28, and we're going to come up with the required rate of return. The market currently is demanding 5.71% for XYZ Company preferred stock.